Good afternoon, small business owners and entrepreneurs. We have a real treat for you. After 30 minutes of listening to this, we're going to be issuing MBAs in small business. Today we have Steve Iskander, the CEO of Intrepid. Intrepid is a leading software platform streamlining the funding process for small business. If you're a small business owner, tap into Intrepid for some really wonderful working capital tools. Also joining us is Anna Bliss. Anna Bliss, also with Intrepid, and she is the head of experience and partnerships. Anna also happens to be a CPA, so we're going to really lean on her tax planning and financial knowledge. And today, this man needs no introduction. It's my partner, Matthew R. Meehan, the CEO of Shield Advisory Group. As you know, Matthew had an illustrious career on Wall Street, and now he's lending his expertise to small businesses in an advisory capacity, whether it's acquisitions, working capital, and debt consolidation. So we have a wonderful privilege to have this wonderful dais here today. Now let's start the conversation with the small business owner is coming off a couple of really interesting years with inflation and with higher wage costs, all sorts of supply chain restrictions. So that company that had a notable profit margin has now a tighter profit margin. So maybe we tapped into working capital too often. Maybe we took on a little bit too much debt over the last couple of years. So let's get them out of this. Let's start the conversation with what tools and tips do you advise small business owners to put in place to prime them for accessing working capital? Matthew, why don't you lead us off?
Well, first of all, thanks for having me on here today. I appreciate it. It always comes back to the same three things, right? If you're looking to borrow money, grow and scale a business, you need to be conscious of the three C's: cash flow, credit, and collateral, okay? Now, you don't have to have all three of them to get funding for your business, but you have to actually have at least one, right? But the more of those three C's that you have, the better off your business is going to be, the better terms and the better rates you're going to see.
Steve, what are you seeing at Intrepid with new submissions and new application? Give us the finger on the pulse.
A lot of what we're feeling, and again, and I appreciate you guys having the Intrepid team on. A lot of what we're seeing today on deal flow that's coming through are a lot of the SMBs, as we like to call them, that are getting squeezed from a credit standpoint through banking. Is small business owners that might not have looked at their financials historically, might have been trending in a downward sloping position, if that's profit margins, cash, credit in general. So we're seeing more and more businesses, Main Street businesses that used to be able to be bankable, they're no longer as eligible as they used to be, and now are reaching out to the private market.
So Steve, let me ask you a question there. Do you believe that's because of all the money the government's pumped into the system after COVID? Right? They may not have been profitable in certain areas, but they had enough money to sustain. Now that money's all dried up.
Yeah.
I think that's what we see on our end a lot right now.
And that's a lot of it. It's not just the forgiveness, or the temporary pauses in these payments from COVID, but I do think that there's a big piece of that money flowed in, kind of land of free money was flowing into these SMBs. They were trying to grow, realizing, or at least hopeful, that they were going to scale out of their current situation with, quote, this free money. And then once that free money ended, we came out post-COVID. As things, in my opinion, continued to slow down, these businesses weren't able to scale out of the conundrum. So although they felt cash rich maybe a year or two ago, it was all fake money that was essentially gifted to them and not necessarily earned through customers and through profit margin.
I couldn't agree more. And I mean, Anna, as being a CPA in a past life, I'm sure you understand the importance of reviewing your profit and loss sheet, right? It'll get better next month. Next quarter will be better. We're just going to take a short-term loss here. Well, before you know it, you're 12 months down the road, you're bloated, and then you got to cut the fat and you got to start trimming. And I think a lot of people seen that in Q1 from what we're seeing. They're starting to cut a little bit more, and they're actually doing what they should have been from day one, keeping an eye on their financials more frequently.
Yeah, Matt, and I think that's one of the things that Anna and I speak regularly about is early indicators on a call with a client or prospective borrower that's looking for capital. One of the questions is just when was the last time they reviewed their finances, let alone reviewed their finances with their accountant. And that's a very telling sign for us about how in tune they are, how accurate, how up to date they are, how polished those financials are. And it's amazing to hear how many SMBs or Main Street businesses don't review their financials ever. I mean, until the end of the
On
year.
that note, Anna, walk us through the importance of finding an accounting team or CPA that is proactive in dealing with the small business owner versus reactive, right? Like Steve says, you want to maintain those quarterly phone calls. You want to have cash flow projections. Walk us through what a small business owner should be doing in maintaining that skill set.
Yeah, so as a small business owner, you want to get an accountant that's going to be available for you. Now, there is going to be some costs, so you want to make sure that you weigh that, but you want someone that's going to be giving you timely reports. I can't tell you how many times I've asked someone, where's your profit and loss statement? Where's your balance sheet? They're like, oh, we don't have one, or I have to wait until the end of the year to get that. That's one of the worst positions you can be in because now you have to go scramble. You really don't understand your financial position. So you want someone that you trust, that's on top of it, that's going to give you timely reports and also help you read those reports, not just send them over through email and say, here you go, but look at this. Here are your margins. This is where we can improve. You had X amount of increase in expenses. Why did your revenue decline? Those types of questions that are super easy for an accountant or a CPA to ask and look at, but you want to make sure that you're finding the right person or company to help you out and look at those and ask you the right questions and tell you kind of where you should be going and where your gaps are.
Anna, can you help us define timely? If it's June 1st, is timely a December 31st P&L or is timely a Q1 P&L?
I'd say at least Q1. It really does depend on your size too, but I would say at least Q1, you should have that by June 1st.
Okay, wonderful.
One of
Now,
the things that Anna touched on is a dependable and reliable accountant. And one of the things that we come across, right, is the difference between expense and a cost. And often we see some of the small businesses that are saving money or reducing their expenses by not hiring an accounting firm or coaching or credit a firm to help them lead them along the way. And they're relying on maybe their brother's girlfriend's little sister that took one accounting course, and that comes out as a cost. So they might have saved the dollar expense, but the cost associated with that is on the back end of trying to get funding, trying to discuss with an underwriter why your financials look the way that they are, or having errors in their credit reports and their financials that are found during the underwriting process just loses credibility. And that expense that the company saved a few dollars on by not hiring an outside firm turned into a true cost to the organization.
Steve, isn't that the scariest sentence for a business advisor? My cousin is my accountant.
Yes, it is always that took one accounting course in high school, but now they're our CFO, and those are all warning signs for providers out there. Not that they can't be great, but there's a lot of questions that linger out there.
Understood.
Yeah, I think we see a lot of people that think that they actually have accountants because that title is so thrown around all the time, but they actually have tax preparers at the end of the day is really all they are. They get them all their documents right before they need to file that extension, right? And then they call them up on the day it's due and say, hey, we just filed. They're not being proactive. They're
So Matt,
definitely being
let's
reactive.
let's be objective here. If you are a young business and you're just starting out and revenue isn't where it will be in a few years, at what point do you pull the trigger on a more robust accounting expense, right? Because maybe that bookkeeper or that cousin kind of helps you in year one, but then as you grow and as revenue scales, you probably need someone on a monthly retainer or a quarterly retainer. How do you know when to make that transition?
I think you should actually set that up almost immediately, right? When you get into business and bake it into your cost structure and have a conversation with whatever tax professional you're going to hire, whether it's a CFO or an accountant. Hey, look, I'm starting out my business. I can't really afford this right now, but I'm looking to stay with you and I'm looking to grow. And as I grow, I'm going to need financing for my company. Here's what I would need. What would it cost for you to do this? I may not need it on a monthly basis because we're not growing that right now. But if can you produce a quarterly P&L for me so I can look it over and give me an hour to sit down with you and review it, right? Those conversations go a long way. The problem is most business owners just don't ask the right questions to the accountants that they hire because it may not be their cousin, but it may be their cousin's brother's dog walker's father that does their books.
Understood. Thank you so much, Matt. Great advice. How important is in your daily job in nurturing a principal's FICO score? I mean, do the options really vary between a 650 and a 750?
Yes, they do. So we like to use the golden 680. If you're above that, there should be good options for you. But lenders are gonna look at your FICO score, how you are as a person, look at your business, also look at your cash flows and your financial statements and all of those. So it is one of the avenues that is important with Intrepid, with our lenders that we work with.
It's absolutely crucial to monitor your credit score, right? I don't care who you are, and I don't care what these gurus tell you on the internet that we're going to get you loans just based upon your EIN number. No, they're not. If they wind up getting you something, it's going to be a vendor account, which is due in 30 days anyway. And guess what? That vendor account, yeah, you may be able to go to Quills, but you can't walk into another vendor that you use and use their credit there, right? So there's a lot of fluff and a lot of hype that goes into this on the internet, but you should always be monitoring and nurturing your personal credit, right? At the end of the day, the lender wants to know who they're lending money to. And it's going to be a reflection of what you did in your past of what they're going to lend to you in the future. So it's everybody out there, whether you're a business owner or just a consumer, you should be monitoring your credit report on a monthly basis.
Great.
Yeah, it's one of the things that we constantly preach is for these business owners to look at their personal credit. Although they talk a lot about, as you're saying, they have business credit, and they haven't paid attention to their own personal credit score. Although I look at it as almost a lie detector test or a look under the hood on how fiduciary responsible is this person with their own capital. And that'll give you early indicators of how responsible they're going to be with our capital when we provide them that capital. And often the trap is, right, they're putting things on their personal credit cards instead of business credit cards and getting lines, not realizing that that's negatively impacting their personal credit score, although they're up to date on all of their payments. And that's later just causing them more griefs, more challenges for them to dig out of had they started the process earlier and had they actually paid attention to their personal credit score despite applying for a business loan.
Good point.
Now, on the flip side of that, though, too, I think it's very important because we're dealing with a case like this right now. I have a client that has almost 800 credit, right, on the personal side, but he's got zero business credit. The company's got no debt. That's a negative too. Lack of credit, on the other hand, will stop you from going further, right? Because you have no repayment history. And, I mean, if you're old school like Luigi, credit card comes in today, he pays it off tomorrow, right? You got to play the game a little bit. You got to let these banks make a little bit of money, right? You don't have to pay all the interest. Don't go out there and keep the credit card open for 30 to 12 months and pay 30% on it. I'm not saying that, but you have to keep it open and not pay it off the same day as cash because they're like, why are we going to extend you more credit? Because the banks need the opportunity to think that they can make money off you. So that's why they'll raise your lines of credit later on. If you're comes in paying it off, chances are they're going to look back and they're going to say, we're going to cut his line and we're not actually going to raise it moving forward. So business credit is extremely important. And a lot of business owners don't actually understand anything about business credit because it's not scored the same way traditional credit is. It's actually, business credit works better in Luigi's case because if you make your payments before they're due, your business credit goes up higher, right? Not on time. And business credit also it's huge, especially when it comes to like SBA loans, right? Because they use the E-Trend system, which is a combination of your personal credit and your business credit. You could have great personal credit and still and be cash flowing and still possibly not get an SBA loan because you had no business credit built up. So it's very important to monitor personal and business credit and build it as well.
And I think you touched on it perfectly, Matt. It's those credit reporting vendors and partners out there that make sure you're paying attention to it early before you're going out to apply for business credit. So although you might not have a derogatory credit score, it's continuing to build the business credit before you need it, and working with those partners, vendors, funding partner providers that will do business credit reporting.
Great points. Now, folks, how critical is the industry in which the small business owner operates? I mean, small businesses come in all shapes and sizes. So you may have a trucking company, you may have a SaaS outfit, you could even have a white collar service provider. How different are the solutions depending on the industry in which they operate? Steve, why don't you start us off on this one?
I was going to pass that one to Anna. That's a very Anna to understand the nuances of the industries and all the things. She can navigate that gauntlet.
Yeah, no problem. Yeah, with the industry, there are going to be harder credit qualifying industries than other ones. So you want to know what that's going to be. And that's part of being knowledgeable before you start your credit journey and getting that experience. There are also certain industries, staffing, trucking, where certain factoring happens, or accounts payable financing, things like that, where those industries are great for those financing products. And so you want to know that, you wouldn't just go in there and say, hey, I want a term loan, but there might be a different financing product for that industry that's even better. So different industries are going to look at the risks involved in how those industries are doing, but then also equally look at what are the financing products that are best for those industries.
Yeah, I mean, there's certain industries when you walk in, it's going to raise a red flag to a bank. It's going to be your construction, one. It's going to be real estate. It's going to be trucking, right? Those three industries, and financial services, right? If you walk into a bank with those NAICS codes, you're starting an uphill battle from day one, okay? So what I always recommend to a lot of my clients is that start a holding company, have a different NAICS code, and have the holding company own that business. But that's just that's a part of a larger strategy, right? One thing that we do see that I want to actually address here is we have clients that they thought they were going to be a home flipper. They started an LLC. It's Luigi's Homes LLC, but they're in the medical industry now 2 years later. They never changed their NAICS code, right? Which they probably should have just opened a new LLC and shut that down. But if you are going to switch industries, let it know, because it may be easier for you to get funding. Talk to your accountant about changing it before your next tax return. So you don't have that uphill battle if you're not in real estate anymore and you're in medical service providing, right? Using that old LLC can come back and haunt you.
Yeah.
Or S Corp or corporation, whatever it is.
Particularly for these companies working with that we touched on, is not just NIC, their code is ensuring that they're getting the right product and service, because they might be walking into an institution requesting a product or service because they don't understand the different lending services or products that are out there that might fit their business a little bit better. So they start going down a one-way path of term loan or line of credit when that might not be the best option for their organization. But because the entity that they went to, that's all that they provide. So the product or service is just as important for these organizations to ensure that that's helps them get to their overall success by having it lined up from the day one on having the right service offering.
That's a great point, Steve. It's like that old saying, you never kill a mosquito with a cannon, right? If you need a new rig or a new trailer for your trucking company, why bother getting an 8-month SBA, right? Let's get an equipment loan to fund it tomorrow.
Yep.
Okay, great. So what other advice would you give to a small business owner in trying to deal with seasonality?
From a seasonality standpoint, I got the tail end of that. From a seasonality, it's something that Anna and I constantly are talking about. How do you navigate the seasonality, especially cash flows or those clients that are on agreements? Are there different ways that you would be able to position your contracts, your purchase orders with your clients to help alleviate seasonality? Or can you work with a funder that understands your industry and the industry seasonality? For example, as Matt brought up, construction has heavy seasonality, especially where they're located throughout the country. And are we able to work with these clients to understand what their seasonality looks like to help streamline, or at least manage that, flatten it out a little bit so that they don't have as many ebbs and flows in their financials, as well as making it a little bit more predictable.
Yeah,
I think,
definitely. Matt.
oh, sorry. I think we got a little bit of a delay here. But anyway, I think going back to the first question and then seasonality, it all ties in, right? You need the right product for the right opportunity. So if you're a seasonal business, a line of credit works good for you because you use it, you pay it off, you use it, it helps you out in your slow months, right? When you're looking at term loans, you're looking at a big purchase, something that's going to be probably a capital expense on the balance sheet, right? You don't really want to take out a term loan for a short-term need, right? It doesn't make sense. And then I think when it comes to alternative financing, these are short-term solutions. You have an opportunity, you need to seize it. It's fast. It's like a speedboat, but you're going to pay high octane fuel prices for that speedboat, right? To run it. So I think there's a need for every different product, but I think seasonality wise, lines of credit come in great for clients.
Yeah, and with that, don't wait until you're in your very low part of your revenue of your year. Like that's the worst time you can try to go out and get financing. Do it while you're doing well and secure that ahead of time. So looking at your projections, your pro forma, how that would affect things is definitely important when you're when you are a very seasonal business. And again, having a good accountant will help you with that, so you know this is the time where I should strike when the iron's hot, instead of waiting and thinking everything's great and then I see a big dip in my business.
The next question, would love to lean on your lifelong expertise here. In operating a business, there is this notion that if the systems and processes are working fine, working capital is fuel on the fire, right? You 10x it, you 20x it. At what point can you advise the small business owners that their SOPs and their procedures and their marketing and everything is working fluidly? When do you execute on working capital, and when do you continue bootstrapping?
For me, I think a lot of that's going to come in from that flywheels. They understand exactly, I put $1 in and what comes out. If you think of it as a machine, regardless of what the industry is, the inputs and the outputs of it, and realizing the more, as you continue to scale and you put more and more capital expenditures and investment in your organization to make sure that coming out of the back end is still the same profit margins and the same of financial security that you were looking for, tells you that you're really on that flywheel of being able to say, okay, I can put $1 in, it's spitting out $1.25 on the back end over and over again. Now it really does turn to a fuel to the fire. However, I will premise it with, just because it is, I call it drag right in Microsoft Excel, you're able to inject substantial amounts of money at this stage. It doesn't mean that you're always going to be able to provide that substantial lump sums of capital, and that'll scale you to maybe your next 5 million or 10 million. You might start realizing that SOPs and procedures are starting to break down. Things are falling apart a little bit more. So what might work and get a company up to a 1 million or a 5 million by putting capital injections might not work to get them from 5 million to 10 million. But it is ultimately that flywheel of understanding what their input, what the output is. That through piece is when it says, okay, pass go, collect $200 and put more fuel on the fire.
Yeah, I definitely agree with that. I think it's really going to come down to knowing your numbers at the end of the day, just like Steve said, right? If we are conscious of what we're putting in and what's coming out, not guessing on what's going to come out, knowing what's going to come out of it. That's the big difference, right? I think that's the time that you do it, but it all comes back down to after you have your SOPs in place, your standard operating procedures, your marketing, your sales team, seeing what's working. When you pour fuel on that fire, like Steve said, there's a chance you're going to break those SOPs, right? So you might have to buy a new piece of software or a new piece of equipment, right? If you're in a service-based industry to expand. So you have to think about that too. It's not just pouring marketing dollars on there, right?
Sure.
And running Facebook ads, because at that time we need to service what comes in too. Controlling the momentum of the business is something that a lot of people don't talk about, right? It's kind of like docking a boat. If anybody's ever driven a boat before, when you go to dock a boat, you have the wind coming against you. Sometimes it's pushing you really forward. Then you have the waves coming in, and you have to control that momentum just to get in there right. I've seen way too many businesses pour that gasoline on the fire and actually burn themselves up in the meantime too. So I think controlling the momentum is really what it comes down to. And it's a hard thing to do when you're growing because we get excited and we want to go.
We've got a couple of questions from the audience. Let's see if the distinguished dais can help out the audience here. So we've got Carl. Carl is asking, what is a recognizable return on investment to show a client to get them to hire a capable accounting firm? Prospects love return on investment reports. Anna, you should probably take this one.
Yeah, I don't know if there's some magical number for that, honestly, but you want getting to know someone, I would say not just the return on investment, but referrals are huge when you're getting an accountant. Asking who's out there, what did they do for you? How was your experience? But from there, you don't want to bite off more than you can chew with an accountant that's going to charge you for every call or something like that. But you want to look at what can they provide, where are we now, where are we going, and what will we need in the future.
Words of wisdom. Let's do a round robin where everyone gives a tip or two to every small business towards a successful 2025. Ladies first. Anna, take it.
Okay. My biggest thing that I see is know who you're working with. You want someone that you trust, not only your team, but your advisors, people on your board, your accountant. And if you're going out for capital, if you're just sending your file out with different brokers and you have no idea what they're doing with it, that is a problem. So know who you're working with and be responsible with your data and make sure that you have a good circle that's there for you, that's going to tell you things that you need to hear, hard truths about the business, what other options you have. So that'd be my one tip.
Yeah, and for us, I like to talk to the founders and talk about their capital stack. And I'll touch base on one of the pieces of advice that Anna said, but really understanding their capital stack. A lot of times companies sit in their boardroom and they talk about their growth, they talk about their sales numbers, they talk about the direction that they're going and all the great things. But part of that growth really is what their capital stack, if that's alternative lending, banking, private equity, venture capital, however they're trying to fund it, that is it. So as companies 6 months out are talking about what their growth trajectory looks like for the second half of 2025, it's right now is when we should be talking to them about trying to get the right capital stack in place before they need the capital. And then the second thing, to just reiterate what Anna said, is the spray and pray method, as I say it. A lot of business owners go out there and work with 6 different brokers trying to find the best deal and pin everybody against each other, not realizing that what they're indirectly doing, they're hurting their own organization by doing that. And they're often getting the redundancy out there. They're getting additional credit pulls on it. Their files flying all over the place without much or any confidentiality. And these business owners, it often seems like, don't realize that. So I think it's one is preparing for your growth, not just from a sales and marketing standpoint, but what your capital stack looks like before you need your capital stack. And second, understanding how you're going to go to the market to fulfill your capital stack, realizing that working across multiple lenders at the same time is probably detrimental to your business.
I love it. I totally agree with everything both of you said. I'm going to bring it full circle again because I'm going to go dive into the P&L, right? Go in there, figure out where the bloated expenses are coming from, right? Find out what products have low margins. You have underperforming revenue streams. Find out where the cash flow choke points really are, right? Too many businesses don't understand that they're bleeding from 1,000 paper cuts, not just one big wound, right? So the minute we can go in there and we can seal up those paper cuts, right? Stitch them up, we'll be in a better shape overall, right? And some of those paper cuts are your business credit and your personal credit. So you need to go in there and not just look at that P&L, but monitor your business credit and your personal credit reports. And I think if you do that, a lot of stuff will take care of itself in the meantime. And you'll have a lot less friction when you have the opportunity to seize and pour more gasoline on the fire, as Luigi would say, to grow.
Well, you folks have given so much food for thought to the small business owners, and we really appreciate having you all here. Steve, can you please tell the audience where they could find you as well as Intrepid? And then Matt, if you could follow up with where they could find Shield Advisory Group as well, please.
Yep. The easiest way to find us is on our website, intrepidfinance.io. It is a .io, not a .com. Or you can email us at getcapital@intrepidfinance.com on .io for any of your questions. I appreciate you, Lou, and Matt having us on today.
Yeah, they can find us at shieldadvisorygroup.com. We're on all the socials. They can go to our newsletter. They can find our podcast at theliquidlunchproject.com, shieldadvisorygroup.com. You want to reach out to me or Luigi, it's just our names on all the socials. It's Matthew R. Meehan and Luigi Rosabianca.
All right. But before we go, there is one last minute question that we got to take. I have a loyal listener. What industries do you see as having the most issues with bankability and being able to secure those lower rates rather than higher credit lines financing? This is from Jameson. Anna, you want to take this one?
Yeah, so as Matt said before, looking at real estate, construction, trucking, those are going to be hard. What we call the sin type businesses, those are going to be hard as well. But any of the businesses, cannabis used to be hot and heavy. We're seeing that tighten up as well. So those are the industries that are really going to have some problems being bankable right now.
All right. Well, to the three of you, thank you so much.
But yeah, guys, this was a blast. Thank you so much for being on here, and let's do it again soon.
Yeah, absolutely. Great seeing you, Matt. Great seeing you, Lou. Appreciate you guys setting this up and all of Jenny's help, and look forward to continue the partnership. Thank you
Awesome.
for everything
Thank you,
you guys
guys.
are doing for
Thanks,
me,
guys.
for sure.
Thanks.
Okay, bye-bye.